Hey everybody, this is Dave with the Compass Options Room and the Compass Options Alert Service. Welcome to the webinar. We'll be starting in just a short period of time here, a few minutes. I just wanted to check to make sure that everybody can hear me and can see my screen that says Compass Options Trading Room and Alert Service Basic Options Training. So if you can see that, please give me a yes in the, and you can hear me. Yep, good deal. Okay, Rodney, hello. Good morning or good afternoon, everybody. I'm here in Charleston, South Carolina, so it's about 10 minutes of 1 here right now, and we're going to try to start around 1 o'clock. We'll try to give some folks some time to log in, and it should take about 45 minutes or so. Depends on how many questions we get, and so we'll get started in just a bit. So again, welcome everybody. I appreciate your taking part of your Saturday, part of your weekend, to listen to me and go over the webinar I'm going to do here for you. I hope you'll find it useful to help your trading. Okay, be back in just a second. Again, hello everybody, and welcome to the webinar. My name is Dave Wise, and I'll be doing the webinar today on Compass Option for the Compass Options Trading Room and Alert Service. We're going to be including some material on a basic options training for anybody who is maybe familiar with options but hasn't really dove into them much, or would like to try to use them but hasn't in the past. I think some of the information we're going to give you here will help you in trading options. So again, hello, good afternoon, good morning, good evening, wherever you happen to be. And I'm here in Charleston, South Carolina. Nice, warm, well, cool day actually here today, in the 60s and a little breezy, but very sunny. So should be a nice afternoon. So again, I appreciate you taking a part of your weekend to listen to my webinar. I'll be very cognizant of your time. I'm trying to do this in about 45 minutes or so. We'll get started in just a few minutes. I want the people logging in here now, so I want to give the folks some time to get logged in, and then we'll get started here in just a few minutes. So again, thanks very much for being here. I appreciate it, and I'm looking forward to giving you as much information as I can to help you. I'll be answering questions along the way if you have something that's related to the topics we're discussing. So again, thanks very much for being here, and I'll be back in just a few minutes. Rodney, you're in Denver. Cloudy in the low 40s. Yeah, not very spring-like, but it's better than the snow you had a week or two ago. I get my family lives up in New Hampshire, and they had 2 feet of snow this week, and it was about 75 down here at the same time. So I'm from New England originally, but I left quite a long time ago to get away from the winters. Yeah, people are logging in here pretty fast right now, so we get a lot of people joining in. So we'll just give them a couple minutes to get in, and we'll get started. I said this will be recorded. Anybody who's registered will get a copy of it, and it should take 45 minutes to an hour. It depends on how many questions there are. Hey, Kumar. Rodney, the mountain's getting up to a foot of snow today. Oh boy. Yeah, spring, winter dies hard sometimes in the mountains. All right, so just about 1 more minute here and we'll get started. Again, I want to thank everybody for coming in here today. If you're an experienced options trader, give me a yes in there so I can get an idea of how many people are actually experienced. I mean, not just you've heard of them before, but you actually use them quite a bit. Oh, good. Yeah, quite a lot of folks. That's good. That's good. Well, some of this stuff maybe in the options, especially the basic stuff, may be redundant for you. But I know there's a lot of folks who haven't, don't really understand options and how to use them. So we'll try to get into that. All right, we'll get started here. It's about a little after 1 o'clock, so we'll get started. So again, my name is Dave, and I'm with I have a Compass Options Trading Room and also a Compass Alert Service. And Compass is the name of a piece of software that I use to identify institutional, if there's institutions in a trade or not in a trade. So today we're going to do that, and we're also going to cover some basic options trading. This is kind of we have a system called the SPY Super System, which I'll touch on briefly. It's just basically it's a specific setup on the SPY to trade for using options for quick trades. These are very, very, very quick trades. So again, my name is Dave. I've been trading professionally for about full time for about 14 years or so, and I always like to start with I don't like to talk about myself, and I'm much more interested in talking about the methodology that I use because anybody can use the methodology to be successful doing this. But I get questions all the time about how I get started in the business and how I went full time. And this is just a very quick story. A lot of people plan for it. They schedule it out a couple of years in advance, look for specific guideposts along the way. Did I meet this criteria, et cetera? What happened to me was I was actually, I was in an IT business. A good friend of mine owned a business in cloud computing. We had a lot of servers and stuff, and I was working for him for several years. And about 2 weeks before Christmas, about 14 years ago, he said he had to lay me off because the cash flow was bad. It had been gotten bad for the last quarter. So that was fine. I mean, I've been trading part-time from the work computer and also from home when I could. So I figured this was a good opportunity to try to go full-time. Now, it was right at the end of the year. It was in December. So end of December, around Christmas time, pretty slow market at that point in time. So December was okay, but nothing great. But in January, I was just trading full time. I wasn't doing anything else, and had a really good month in January. And the market would help, but I had a very good month in January. February came along, it continued, had a very good about 3 weeks. And after about 3 weeks, my boss, who was a good friend of mine, called me up and asked me to come on back to work. Said things had picked up. They've gotten a bunch of new customers, and come on back and start on Monday. And I had to tell him that I appreciate the offer. You know, that Greg enjoyed working with him, but I really couldn't afford to come back and work for him anymore. And that's how I started. Basically, I got laid off and did this, and was able to turn that into basically just trading full time all the time, and haven't looked back at it. Very obviously, I prefer working for myself as opposed to anybody else. So that worked out pretty good. But that's how it happened to me. So that's how I get started trading full time. All right, so let's get started here. First thing we want to do is go over the disclaimer. All the signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so I won't be giving financial advice. All right. By the way, if you have any questions that I can't answer, or you want to get some more specifics on the Compass system or on my options room or my alert service, just put your name and number in the chat box or in the question box, or your Skype username, and Rory from Right Line will call you just to answer your questions. He's not going to try to sell you anything, but he'll just call you. So this is the number, his number, and I'll put this up again at the end. But just know that you can put something in the question box if you have any questions for me. I'll be watching. All right, so this is just kind of a graphic of the SPY Super System. These charts here that you see, that's actually the Compass system on ThinkorSwim, and I'll show you that here in just a couple of minutes. So, and this is what the alert service looks like. It comes out on your phone. It's SMS text alerts. Come right from when I take a trade, or I find a nice trade and take a trade. It goes out by text alert to you. You get it in a very quick period of time, so that you can follow those trades. And I'll go into some detail about how this alert service works here in just a little bit. I want to talk about, before we get started into the actual presentation of the meat of it, I want to talk about the market and understanding what drives markets, what drives the S&P 500, or every particular stock, what drives them. And there's two kind of types of traders. There's retail traders such as myself and most likely everybody here. We're retail traders, and we're these little marbles right here. When the retail traders are trading a stock or trading an index by themselves with not any institutional involvement, you don't have any trends that you can follow. This retail traders just cause chaos and chop. That's all we do. When retail traders are in there battling it out with each other, they just cause chop and chaos. And it's not a market you want to be trading in when retail traders are in the trade only. This big marble here, this is the institutions. And institutions, we don't hear about institutions. It's the big banks. It's Morgan Stanley, Goldman Sachs, JP Morgan. All the big banks have huge arms that do trading. And they also have algos. They have computerized trading systems where most of the trades come from now. 75, 80% of the trades come from computerized trading using algos, and they have programs that look for specific setups and specific criteria, and they generate buy and sell orders based on that. They also look at the news. They have optical scanners that look at the news coming out, and they read those, and they look for key words and key sentences, and they'll trade off of those. If you've ever looked at for example, when the FOMC comes out, the Fed meeting or the jobs report, if you watch the market, if the FOMC report comes out at 2 p.m., you'll see at 2 p.m. in a microsecond, the market will start shooting up or shooting down. That's not people. that's trading that. That's the algos, and algos are very, very strong, and it's really important to be able to understand what the institutions are doing, because those are what's driving this. So the institutions are made up of the investment banks, again, Goldman Sachs, Morgan Stanley, JP Morgan, et cetera. They're also made up of the hedge funds. Think of hundreds and hundreds of hedge funds and how many billions of dollars that they've got to put into the market. And then there's pension funds, huge pension funds for state employees, firemen, policemen, et cetera. They all have pension funds, and these pension funds control a huge amount of money. And they also are investing and trading in the market all the time. And then you also have, for example, things like Vanguard and T. Rowe Price, mutual funds. There's tons of mutual funds, and they have trillions of dollars to be able to put into these things, or at least billions to put into the market. So that's what the institutions are. So our job as a retail trader, if we want to make money in the market, is we need to know if the market right now is being driven by institutions or just retail traders. So the job we have is to find out when the institutions are in a trade and find out when they're not in a trade, and basically follow them. Because it's important to understand that as retail traders, we're not going to take any money from the institutions. You hear a lot of talk about Wall Street bots, et cetera, bets, et cetera, that they can take money from the big boys. You can't. Our money is going to be made from other retail traders that don't know what we know. They don't have the information or the tools that we have. And this is where we make our money. All right, so I have in the room, and for the alert service, I have a couple of rules that we trade by. First one is we say trade the best and skip the rest. And it sounds easy, and it's very important though. You don't want to be trading anything except the very best trades, because it gives you the highest probability of success, obviously. And the second thing is when you're in a room, when you're in my room or alert service, et cetera, my objective is not to make trades. My objective is to make money. And some people think that's odd, but what this is meant to do is to keep people from just taking trades willy-nilly during the day just because they feel like they're a trader and I need to be in a trade. You don't need to be in a trade. Sometimes the best trade is a no trade. I mean, I have days during the week where we haven't taken a trade because the market just doesn't, it's not conducive for it. We don't have the very best trade set up, so we skip them. We keep the money in our pocket. So this is meant to make people patient and to stay away from just taking trades just to be a trader. Now, we, as a profitable traders, we do need an edge. We need an edge over other retail traders. These are our edges that we have in the compass room and on the alert service. We have the right line compass system. This is the piece of software that I'll show you that runs on ThinkorSwim, and it runs on Ninja, and it basically identifies when institutions are in a trade and when they're not. And when they're in a trade, those are the trades we want to be in. We don't want to be in every one. We want to only take the very best, but we want to know when they're there. If the institutions aren't in a trade, we're not going to be trading that stock. We also trade the second thing here, which is called relative strength and relative weakness. And this kind of goes hand in hand with institutional trading. Typically, if a stock has got relative strength, and I don't mean RSI here, I mean if the stock is moving up when the SPY is moving sideways or down, it has relative strength, and vice versa on the weakness. This reinforces the fact that it's institutions that are in here into this trade. Jerry, did I say the compass system runs on Ninja? Yeah, it's actually called the money flow tracker over there, but it's the same system, but it'll run on the Ninja platform. Third thing is that we want to trade with the market trend. In other words, when the market is trending up or trending down, we want to trade in the direction of the market. It gives us an additional edge. You don't want to be trading against the market. If the market doesn't have any trend, then it's chopping. Then we focus on whether the institutions are in there taking the very best trades, looking for relative strength and relative weakness. And the fourth thing we look at is when we want to get into a stock, we don't want to chase it. If the stock is moving up fast, we don't want to be jumping in at the top. And if it's moving down fast, we don't want to get in at the bottom. We want the stock to pull back to support, and then find confirmation that support is holding, and then bounce back into the original trend. That's when we want to get in. And that gets us in at a better price with a less likelihood of any kind of a loss. Okay, so the compass system, I'll talk about the compass system, which is a piece of software that runs on, I use it on ThinkorSwim, and I'll show you that. As I said, it also runs on Ninja. But what it does is identifies the highest probability trade setups while sidestepping setups that look good but will fail more often than they succeed. And that's done by identifying when institutions are in a trade and when they're not. We need to know that. And the way the compass system does this, I'll explain this to you. It's extremely, extremely helpful. This compass system analyzes complex trading data and displays the results in easily identifiable visual format. In other words, it's using color coding to let you know whether the institutions are in the trade or not. So it's easy for even a novice trader to determine whether the stock is being driven by institutions or not. And that makes it really, really helpful because you don't have to get into a lot of technical analysis just to know if an institution's in there. Okay. Now, again, getting an edge over the other retail traders. Remember, we're trading against other retail traders. Well, who are the institutional traders? We talked about that. We have to identify if they're in the trade and if they're not. We only take trades that are being driven by institutions, very important. We trade stocks that have relative strength, and this is reiterating what I just said in the last slide, and trade in the direction of the overall market. That's a big edge. And how does it give us an edge? Our trades are going to be supported by institutional buying or selling. We're in there, and we're basically following the breadcrumbs that the institutions are dropping. We'll be outperforming the SPY if we're going long or short, but since it has relative strength or relative weakness, we'll be outperforming the SPY, and the stocks will be moving in the direction of the overall market. All of these things give us a huge edge. All right. Let's see if we have any questions here. Okay, thanks. Somebody said they took a bunch of trades that I had and off of the alerts this week and did well. Yeah, we had a good week this week. So this is basically the highest probability trade funnel setup that I have, or trade setup funnel. This is just kind of a way to visually show you how you find the best trades to take. There's more to it than this, but this is how they start. The first thing I always look at is, if I'm looking at a stock, I want the daily chart and the 5-minute chart to be aligned. So if I'm going long a stock, the daily chart has got to be bullish. I don't want to take a stock that looks good on the 5-minute chart if it has a bearish daily chart, because you've taken away all your flexibility to stay in the trade through the day or and overnight or even for a week or whatever. You've got to be trading in the direction of the daily chart. So that's critical. I won't take any trades that don't have a daily chart that's bullish if I'm going long and a daily chart that's bearish if I'm going short. Then we want to trade with the trend, both stock and the market trend. And the market, again, sometimes chops around, but the stock typically will have a trend. When you look at a stock chart, you should be able to determine if that stock is trending up or trending down. If you can't tell, don't trade it. The next thing is, once those things are met, I look at the compass indicators. The compass indicators have to be aligned. In other words, they need to tell me that the institutions are in that trade right now. If that particular indicator fails, then I'm not going to take the trade. I only want to be in trade that the institutions are in. And then I look for relative strength and relative weakness in the stock. Does it have relative strength or relative weakness to the S&P 500? Well, you can use the Qs, but either one of those. So if all of those are true, then I say, are we near a support or resistance level? If not, I'll probably put an alert at the support or resistance level. That could be the volume weighted average price. It could be a moving average. There's many support and resistance levels. I won't get into every single one, but there's a lot. So if a stock meets all of these criteria, it falls out the bottom. It now becomes a prospect, not a trade. You're not going to trade it necessarily, but you're going to look deeper into that trade to see if it's a good trade to start with. So again, this is the funnel method. I'll just go over these quickly. Again, identify the market trend for the day if there is one. Make sure the daily chart and the 5-minute chart are aligned. That's critical. Make sure the compass system is aligned in the direction of the trade. In other words, make sure the institutions are in the trade. Very important. Then you look at relative strength, relative weakness. On the 5-minute chart, if you're going to go long, make sure the stock price is above the volume weighted average price, the VWAP. I'll show you that on a chart. And if you're going to be short, it needs to be below the VWAP. You want to wait till the stock gets above or below the VWAP. The VWAP is something that the institutions use all the time for entries and exits from trades. And I'll show you that on the chart. And again, try to enter near a confirmed support for long and near as a resistance level for short. And you want to look at the daily chart and make sure there's no nearby support or resistance on the daily chart to limit your profit target. You know, if you're in a trade in the daily chart, you're 20 cents away from the 200-day moving average on the daily chart. You don't want to be going long. You know, you get 20 cents of room to the upside. That's not enough. And the very key thing, and we go over this every day in the room, is to have patience. You've got to have patience. That's one of the hardest things for traders to do, is to not to have patience. They just take trades. They get antsy. They won't stop and just watch the market before they trade in. They just feel like they got to be in there. This is really, really important. All right, so I want to kind of quickly go over what we use in the trading room and the alert service for trades. And most of the trades I do are going to be option trades. Now that doesn't mean if I put a trade out there that we're going long calls, doesn't mean you can't buy the stock. You certainly can. If you want to trade stock instead of options for straight calls and puts, yeah, you can go long the stock, or you can short the stock. But I don't do that very often. Occasionally, but very rarely. We use debit spreads using weekly options expiration. This works really, really well. We've had some really good success with this. I won't go into the details of why I use weekly options expiration. Just know that you get a better ROI using the weekly expiration than if you go out several weeks. I also use a strategy called time spreads. We do this over earnings. It's typically called the calendar spread. All this is meant to do is capture the volatility crush when the earnings come out. And I'll go over that in the options information as far as what volatility crush is and how we can make money on over earnings by taking time spreads. This is a non-directional trade. We don't care whether the stock goes up or goes down. We're just looking to gain advantage by taking the volatility crush when that occurs and capturing that premium. I never trade options over earnings trying to guess which way the stock's going to go. I also have a strategy called the weekly ATM strategy. This is kind of a longer term strategy that we sell puts on a stock that's neutral to bullish, and we sell them every week, and we have it a longer dated long put further out in time at a lower price to protect us in case the stock turns against us. Really nice strategy. We have one of these on Oracle right now. And then I do credit spreads, standard credit spreads to capture premium over a few weeks. Typically I'm doing put credit spreads. I don't do too many call credit spreads because those are a bear strategy and the market generally is bullish. So we do credit spreads. And then we have the SPY super system. This is not something that I alert on. This is something that we talk about in the room. We'll call them out in the room if they occur. They don't occur very often. You need to have a specific setup to take a SPY super system trade, but we do have them, and they're very successful when they work. They're just not an awful lot of them. Okay, any other questions here? Well, what does relative strength relative to SPY mean? Relative strength means if you look at the S&P 500, if you look at the SPY on a 5-minute basis, the S&P 500 is just the SPY. If you look at the chart of the SPY in the 5-minute and you look at the chart of the stock you want to trade on the 5-minute, if the S&P 500 or the SPY is moving sideways or down and your stock is moving up, that's relative strength. In other words, it's outperforming the SPY to the upside. If the SPY is moving sideways or up and your stock is moving down, then you have relative weakness. That's relative weakness to the SPY. That gives you an edge because that stock, what happens is if the market turns against your position, because you have relative strength or relative weakness, the stock is not going to react as harshly to the move in the SPY as the other stocks will, because it has relative strength or relative weakness, and you'll be able to mitigate any kind of losses on that. That's what it is. Okay, got it. Thanks, very good. Appreciate the question. Okay, so the Compass Options Alert Service, it's basically designed for day trades and short-term swing trades. These are not investments. We're not talking about investments in this service. This is trading. It's day trades. I do intraday trades. We do short-term swing trades. Which short-term swing trades I call overnight to maybe 2 weeks, 3 weeks maximum. Just depends on how long I want to hold on to it. But that's what these are. These are not investment trades or 3-month trades or anything like that. It's the alert service is designed for traders who can't watch or don't want to watch the market all day long. I watch the market all day long. I've been doing it for a long time. A lot of people don't want to spend their whole time sitting in front of the computer, so the alert service is perfect for them. You're going to get real-time alerts on the highest probability trade setup. So and I'll go over the criteria I use for high probability trade setups. But what you'll be able to see is if you get an alert, you should be able to look at the chart and have a pretty good understanding of why I took that trade. And a lot of people don't care. I mean, they just get the alerts to make money. They just want to make money. And when we do make money, but some people like to know, where are these alerts coming from? Why is the stock being chosen? So I'll go over what those criteria are. Again, how do we find the highest probability trades? We identify institutional involvement. Are the institutions in the trade? What's the market internals? Market internals would be what is the actual market doing as far as stocks going up versus stocks going down. And then we look at technical analysis. And all these things together is what gives us the highest probability trade setup. And again, I start with that funnel that I showed earlier. This is just a cumulative P&L. This is typically what we do over. This is like a 90 days. This is from the fall. I haven't done an updated one on this, but this is the kind of graph you want to see on your P&L. I mean, you want to go bottom left, up, right. You get losses along the way, but this is the overall trend you want to see. All right, so what I'm going to do is I'm going to cover some of the results that we've had with the trades that we've taken since I started here back in September. We had a good year, and I'll cover the last year, 2023. But one of the reasons I'm showing this is obviously I'm showing it to show what our record is, because people want to know how's this service going to work for me. But one of the things I want people to be aware of is the percentage gains that we typically take on trades. I know you get a lot of emails, you've seen webinars where people are promising you some pretty astronomical success. You're going to get 1,000%, 500%, 300% on every trade. That's just not sustainable. You've got to be taking way out of the money calls or puts, or you got to know something. There has to be a buyout coming to something that you got to know about to do that. You can't do it consistently. So what you see here is the percentage gains that we take on our trades, typically going to be anywhere from usually from 20 to 40 to 50% or something like that. And we do have some losses. It's obviously important to understand that not every trade is going to be a winner. There's going to be some losses. But this is September. We had a good win in STX in September, 108%. That was pretty high. But generally speaking, you can see they're in the 10, 20, 30, 40% range on the trades that we take. But in September, we had 25 wins and 2 losses. That's a 92% win rate. That's about as high as I can get usually. Generally, it's between 85 and 90%. But if you invested 2,000, and this is an arbitrary number, what I need to do is just figure out, people want to know how much am I going to make. So I tell them that if you use 2,000 invested in each trade that came out, it created a profit of $7,788 in September. So that was a pretty good win right there. And I did note that September trading results were outstanding, and it was achieved in a very difficult market condition. And that's because we wait and wait and wait and look for only the highest probability setups. And we only took 5% in Square and 7% in Tesla, a couple of small wins. But this was in a market that most people were losing money. Let's see, do I only trade trades that are on the S&P 500? I don't, Brian, I know. I trade more stocks than just the S&P 500. But basically, I'm looking at most of the stocks that are typically over $10 that are in the Russell 2000. Okay, so this is October here. Again, you can see, and again, the point is to see the percentage gains. We're talking about pretty much the same thing. We had some losers here, but we had 24 wins and 4 losses, 86% win rate, 44.80. That was less profits in September. Still a nice month, but you have to keep in mind that a lot of the profitability is based on what the market's doing. Choppy markets is much more difficult to make money than trending markets, because you have to get out more quickly. You've got to take quicker profits. You don't have a chance to stay in them for 3 or 4 days and get big run-ups. So when the market's choppy, your profits is going to go down, even if your win rate goes up sometimes. And again, we had some losses in there, but you can see again, 32%, 20%, 23, 33. These are the kind of percentages you can expect on the trades that come through the alert service and in the room. It's going to be fairly consistent like that. Here's November. Okay, 21 wins, 4 losses, 84% win rate. See here the 84% win rate, we did 5160, but an 86% win rate, we did 4480. It depends on the market. And here's the percentage gains again. And people think, well, that's not very much money. Let me tell you something. If you can average 20% on every trade you make, and you got an 85% win rate, at the end of the year, you're going to have a huge gain in your portfolio. Dwayne, how long do the trades usually last? I mean, it's hard to say. It depends on the market. It depends on the stock. If I get into a trade in the like 11, 12 o'clock, and I'm up 30%, 35, 40% by the end of the day, I'll typically take it off and lock in the profits. But if I haven't got to the profit target and it's still bullish, obviously, and I want to hold it overnight as a put, as a call, then I'll stay in it 1-2 days. Sometimes I've had them go as long as 3 weeks, but typically we're out of them in about 3 or 4 days. Dwayne, do I look to reduce the minimum amount of loss you take on a stock? The loss I take is based on the technicals on the stock. I'll get into this later, but anybody who tries to set stop losses bet a 10% or 15% loss or a $100 loss without using technicals to guide them is making a mistake. Because I know a lot of people getting into trades that I'm in, the trade goes against them, they bail on the trade, and I'll say I'm not getting out of it, it's still bullish. 3 days later, they get out for a loss and we're out for a profit. That happens a lot. You can cut down the size of your losses, but you're also going to cut down your win rate, which can hurt. All right, so here's the November trade again. You can see the percentages again: 15, 22, 23, 13, 31, all across the board. This was a strangle. This was a credit spread. Another put credit spread here for 25%. But you can see the percentages are pretty much all in line. And again, 21 and 4, 84% win rate. 2,000 netted 5160. All right, move ahead here. December. Same information here. We had some nice wins: 36, 25, 63 on Microsoft. Microsoft 31. Microsoft was a nice trade for us. Didn't do a lot of trades in December. Christmas, New Year's coming up. There wasn't a lot of good trading opportunities. Didn't trade, but 14 wins and 2 losses. 87% win rate, 31.15 profits. They're not bad. I mean, that's pretty good, but for so few trades. All right, January, cranked it up a little bit here. We had 20 wins and 2 losses in January, 90% win rate, 2,000 invested, netted 7,500, pretty nice. And again, you see we had debit spreads, time spreads, credit spreads. We have some of everything here. Percentages, they look pretty much the same. Gilead, we took a hit on Gilead as news came out and hurt us on that one. But that you can't do anything about that. But that was a nice month of January. February, I have detailed here, 24 wins and 2 losses. I started to split out the alerted trades because we don't alert on every trade I take in the room for a couple of reasons. First of all, if I take a trade at 3:50, 10 minutes of 4, it's not fair to the alert service to send that out because likely they're not going to be able to get in. Or if I take a trade in the room and I expect to only be in it for an hour or less, then I don't send them out. And I do experimental trades in there and stuff, and I don't send those out in alerts. So alerts are only the highest ones. But this was February. Again, you can see the percentages again. 40% here, a nice PayPal, 56%. It just stays the same. These are all pretty good. We didn't have, except for this 0%, we didn't really have any low percentages this month. AMD was 80. These are pretty nice. But February, we had 24 wins and 2 losses in the room for 92% win rate, 2,000 invested. It generated 11,745. Pretty nice month. On the alerted trades, we had 20 wins and 2 losses. Now, all the trades in the alert service are in the room, but not all the trades in the room on the alert service. So in alert service, we had 20 wins, 2 losses. Again, that's another 90% win rate. And 2,000 invested, netted 6,930 in the room and on the alert service. I just want to show the difference between the room and the alert service. Both pretty nice, actually. So then I didn't do the March ones. We actually had a small loss in March, but I wanted to just cover the quarterly stuff. We had a loss by about $600 in the room, but a profit about $3,400 on the alert service. But for first quarter 2024, these were our trading results in the room. 65 wins, 11 losses, 86% win rate, 18,763 total profits. Alert service, 41 wins, 6 losses, 87% win rate, a little over 12,000 profit. They're pretty nice for the quarter. This pretty much corresponds to exactly what we did last year. As you'll see the results of 2023, this is typically what you're going to see. This was our 2023 trading results, using $2,000 per trade, investing $2,000 in each trade taken in the Compass Options room, produced a profit of $60,208. So basically $60,000. So I just use this as a hypothetical. If you had an account of $50,000, each trade used 4% of the account balance when you first started, and then that percentage of the account lowered as the account grew, and it produced 120% return on the initial 50,000 account. This is what I said, when those percentages that don't look very big, 10%, 20%, 30%, they over a period of time, they're a lot. So that's 120% return on a $50,000 investment is pretty huge. So your account would have grown to 110,000 at the end of the year. So that means at the end of the year, if you were still putting 2,000 into a trade, you were only using 2% of your account balance to produce that. And this was our April. I just threw this together last night. This is our April trade so far. We've had 6 trades in the room, all winners so far. I can see this Lulu was 57%. We did a couple of strangles. We did a debit spread. So April's 6 wins so far. We've netted 34.90. So this is in 1 week, $3,500 roughly in a week. The alerts, we had 4 wins. 4 of those went out to the alert service. 2,000 in each one, netted 24.50. It's a pretty nice week to start April with. All right, let me see if we have a couple of questions here. On average, how much dollar-wise 2K do you usually have in play? Number of trades. Yeah, I would, I understand what you're saying. Typically, we right now we've got, I think we got 4 trades in play right now. One of them is a credit spread, which doesn't take up a lot of margin. And another one is a weekly ATM, which again is a fairly low risk type trade. And then we have a couple of straight calls on as well. So I would say the most we ever usually get to is about, on the alert services, probably 4 or 5. In the room, we might get up as high as 6 or 7, but mostly it's anywhere between 3 and 5. Yeah, open positions, Mark, that's about generally 3 to 5. Sometimes 0. I mean, sometimes we close things out, we don't have any, but that's typical. With a 50,000, can you trade using both the room and the alert service simultaneously? Well, if you're in the room, you get the alerts anyway, okay? But the alert service is for folks who don't want to be in the room and can't be in the room. People are in the room, we get the alerts, but they don't really need them because they're in the room. It's the same trades. I had a huge winner on Root. Yes, I had a huge winner on Root, is right. Root was a big, huge winner for us this week. Really, really big. So that was a nice one. All right, so we'll move ahead here. Yeah, we've had some good trades lately. So, okay. So on the alerts, and I'm going to do a little bit of this, and then I'm going to get into the options information because I know everybody is interested in the option information. So these trade alerts are going to come out by SMS message. Again, trade the best, skip the rest. I emphasize this and have patience are the 2 things I emphasize every single day. And the room, by the way, is I'm in there from market open to market close. It's not like a 2-hour window where you can trade for 2 hours. No, we trade all day long because I don't know when the best trades are going to come along. I really don't. So I need to look for the best trades. Usually I'll step away for half an hour or so for lunch, but typically speaking, I'm watching the market all day. So when you get an alert, it's going to show the stock symbol. It's going to show the option strike price. It's going to show the expiration date, and it's going to show what you should pay for the option. Now that may be a range. That may be $1 to $1.05 or something like that. And if you get an alert, and by the time the alert comes to you, and it doesn't take long, but sometimes the stock's moving fast, don't chase it. Just put the order in at the price that was on the alert. Wait for the stock to pull back. It usually will, and you usually will be able to get filled at that price. But I don't think you should be chasing. If it's say $1 to $1.05, don't pay $1.25 for it. Now the exit price, sometimes I'll put on an alert that includes the take profit target or the price that you want to sell it at in the original order. But generally, I don't do that. I do that for time spreads, but that's about all. Otherwise, what I do is I watch the price action on the stock and make a determination of where we want to take profits. Once I decide where I think we want to take profits, I'll send an alert out with the take profit target. You can put the order in to sell it at that price and leave it as good till canceled. So if you don't close out that day, it'll still be working in the morning when the market's open, even if you're not watching it. Okay. Alan, you say you use the ThinkorSwim app on your phone. It takes you 15 seconds to take the trade, and I always have time to take the trade. That's good. I'm glad to hear that. Marvin, I'll get into that. You're talking about what's the rule in the strangles for every situation with a bigger move, the less profit you make. Generally, no. Generally, no. Not on a strangle. Okay, so this is, I want to just kind of go over how we find this, get these trades that we're showing these results on. These are really, really great results. So it's important to understand, to some people don't care, but how do we achieve these things? We're able to identify when institutions are driving a trade. I keep saying this is how important this is. We want to be in the trade when the institutions are in there and when the market internals are heavy. Now, I say we only take trades when both of these are in our favor, but that's not really true. If the market internals are neutral, in other words, the market shows to be just chopping, but the institutions are still in the trade, we'll take the trade. All right? So that's when they're aligned, we take them. That even gives us a higher probability of success. So how do we identify these institutions? Well, we do what's called, the Compass system does what's called a triple screen assessment. This is a fancy way of saying, some people call this fractals. It's basically multiple time frames. And we look at multiple time frames on momentum, trend, and money flow. These three things, okay, momentum, trend, and money flow. So when they're all, if the momentum is moving up on multiple time frames, the trend is moving up on multiple time frames, and we've got solid money flow going on at the same time, the likelihood of that stock moving up on anything but institutional buying is very, very small. And we're in the upper 90% likelihood that the institutions are in there. Doesn't mean they're going to be in there half an hour from now, but they're in there right now. I just kind of wanted to show you what the Compass system is. Now I'm going to show you some more charts later on after we get through the options, but I just wanted to show you one quickly. This was a trade we took in Tesla. These are Fibonacci candles, different kind of candles that you can use from time to time. But this kind of just shows you what the Compass system is. Now, when everything is green or blue across the board on these indicators, then you obviously get institutions in. You can see the institutions are buying the heck out of Tesla on this particular trade. This, by the way, is a long-term trend. This is multi-time frame momentum, current time frame momentum, and this is a money flow derivative that is looked for. So we're looking for this. This obviously is being bought heavily, and we actually bought it right here. This little pink arrow right here is what's called a pop out of the box or a pop signal. The Compass system creates these when a breakout of compression occurs. And there's some other things on here. This is the 15 EMA of an EMA, and we'll cover some of these. But there is a lot of things the Compass system does to help us find when institutions are in there and find the best trade setups. Okay, we're going to talk about options. Let me just see if there's any questions. How do I determine the target? Very complicated for me to try to get into what the target should be. I'm always looking at where the next support or resistance level is. That's likely to be a target. But I'm also looking at what the market's doing. If we get a choppy market day, then I'm going to be looking at basically taking profits when the momentum stalls on that stock, and then maybe looking to re-enter later. If the market's trending, then I can set my sell target higher. Sarah, you haven't chosen to do strangles, just straight calls or puts. That's fine. Nothing wrong with that. When you use a strangle, can you still participate in the trade? Yes, you can participate in any of them. Strangles are something I'm doing, but I'm going over them in the room. I haven't done them on alerts yet. It's a trade that I'm working on to make sure that it's going to meet my criteria, which is 85 to 90%. But yeah, it's been pretty good. But you can still participate in the trade, sure. But if you're gonna go long, remember, I'll go over this in the options. That there's neutral trades using options, there's bullish trades using options, and there's bearish trades using options. So the neutral trades would not be something that you would want to be doing straight calls or straight puts on. Alan, is there any advantage to taking butterflies? Yeah, we can talk a little bit about butterflies. That's one of the criterion here. The advantage on butterflies is the risk reward is great, but you've got to be able to identify where the stock price is going to sit at expiration. You have to really be good at doing technical analysis, determining approximately where the stock price is going to end, because most of the money on butterflies is made very close to the expiration date. All right, so we're going to talk about options here. First thing I want to do is just kind of pop up on the screen an option chain. This is what an option chain looks like. This happens to be Bristol-Myers. This is a ThinkorSwim option chain, but they're all going to be the same. So for anybody that's not familiar with options, this is what an option chain looks like. There's a few things on here. This side of the option chain, these are all calls. Calls are always on the left. Puts are on the right. Right. So you've got the calls and puts. This in the middle here, this is the strike price. This is the strike price that you're looking for that stock to get to. So these are all your strike prices. Over here, towards the top, these are expiration dates. Okay, so you got expiration March 15th, March 22nd, March 28th. Bristol-Myers has a weekly options expiration. So you would just click on one of these and it's going to show you the bid and ask, et cetera, for each one of these. So if you look at Bristol-Myers at this point in time, it was trading at 53.79. So basically the in the money, at the money option is pretty close to 54. This would be the at the money option right here. And this is the bid. This is how much being bid at it. So this is what somebody is bidding to buy it at. And 66 is what somebody is asking for the sell price. So this is your spread. This is your bid ask spread right here. Right. So that's you'd like that to be fairly tight. Sometimes it can get pretty wide, but you like that to be fairly tight because you're trying to hit somewhere in the midpoint. You'd be trying to get filled on this. If you were trying to get filled on it 61 to 66, you're probably trying to get filled at around 63 to 64 cents. Right. This thing in the middle here, this is a delta. It says the delta. The white number is a delta. The delta, if you see, it's around 50 at the money price. And you notice as you go into the money, these options are in the money because it's the strike price is less than the stock price. The delta goes up. All right. We're going to talk about delta. And as you get away from the strike price, as they become more out of the money, the delta goes down. All right. Same thing on the calls. Same thing here on the, because you notice at the 54, you see this 52 delta. You see over here 48. Notice that 52 and 48 comes out to 100. All right. So one other screen here. This is the same thing, but what I put in here is OIVOL. This is open interest in volume. This is how much open interest is. In other words, how many outstanding contracts are there at each one of these strike prices that are out there at the beginning of the day. Open interest identifies the open interest at the beginning of the day. It does not include any of the trades that went through today. So if you look at the 54 here on Bristol-Myers, you notice that it says 643 in blue. That's how many trades have gone through today. That's the volume. The 1,004 is open interest. So at the beginning of the day, there was 1,004 contracts still outstanding at the 54 strike price. And at the end of each day, it's modified. You're going to get a new open interest, which is going to include anything that's in there today minus everything that was closed out today. All right, so that's a couple of things that are in there. All right, so I want to go into options here. I don't want to take too long doing all this stuff, but we got some details to cover here. What platform is this? Yeah, it's TOS, doing ThinkorSwim. Yeah, I use charts on TOS, and I trade on Tradier. I use a program called TradeHawk, a piece of software called TradeHawk. It has a front end to Tradier. I choose Tradier because the commissions are so low, basically nothing. I think I pay 20 bucks a month or something for unlimited options and in stock trades. But Tradier, you cannot trade FX or futures on Tradier. And if you're going to trade futures, then you want to be on something like Ninja. All right, so we're going to talk about, this is just kind of a list of what we're going to talk about here. We're going to talk about what options are, what makes up the premium of an option. We're going to try to understand intrinsic versus extrinsic value. We're going to cover the Greeks a little bit. I'm not going to go into, I don't use Greeks an awful lot. I do use some Greeks. Then we'll look at the strike price and expiration dates, volume and open interest. We talked about the primary option trades that are available to us. Then we're going to talk about what option strategies are bullish, what are bearish, which are neutral, and the setups for some of these trades. Right? We're just going to run through this pretty quickly. I just kind of wanted to get an overview of these things. It could take hours to go through all of this. And Tradier, I said, Mark, yeah, Tradier, TR, that's right, Tradier. But you can go to Tradier, or you can go to TradeHawk and get into it either way. All right, so we're going to talk quickly about calls and puts. All right, you can either buy a call or sell a call. All right, or you buy a put or sell a put. You're buying a call, it's a bullish. You're selling a call, it's bearish. You're buying a put, it's bearish, and selling a put is bullish. But there's again, you can buy or sell either one of these. When you buy, you are long a call or a put. When you sell, you are short a call or a put. So when you're selling, you're actually short. When you're buying, you're actually long. So if you buy a call, it's bullish. If you sell a call, it's bearish. You're expecting if you're selling a call, you're expecting the call price to go down. When you buy a call, you're expecting it to go up. So buying puts is bearish and selling puts is bullish. Just the opposite. So what makes up option premium price? And again, options can be at the money, which is meaning if the strike price is 100 and the stock's trading at $99.90 or $100.10, at the money would be a $100 call or a $100 put. It can be in the money. In other words, if you've got a stock price is 100, the $95 call is in the money. The stock is price is higher than the call price, or out of the money. If the stock price is 100 and you buy a $105 call, you're out of the money. The stock has to move up $5 to get to that strike price. And I never use these out of the money, right? So it's the option premium price is made up of the stock price. Obviously, what's the price of the stock relative to the option for it? The intrinsic value. Intrinsic value is how much of the stock price in the option price is reflected in the stock. If you have a stock that's trading at $50 and you buy a let's say the stock's trading at 55 and you buy a $50 call, you've got $5 of intrinsic value because the stock price is already $5 higher than your strike price. So that the amount of the price of the option that's in the money is called intrinsic value. So the stock price, if the stock is 50 and if the option price is 50, you're going for a 50 strike, and the stock price is 55, you've got $5 of intrinsic value. So that option has to be worth at least $5. So you're going to pay at least $5 for it, but you're going to pay more than $5 for it. And there's two reasons for that. There's implied volatility. In other words, how much does this stock move? Moves around a lot. It's going to have a higher implied volatility. They're going to add that to the premium. And time decay. How much time is there between the day you buy this and the expiration date? Both of these things are going to be added to the price of the option. So that's what you're paying for. That's the additional price that you're paying for the option over and above the intrinsic value. And that's what the market makers are looking at. So when they're setting the premium on an option, they're looking at how much is it in the money, how much intrinsic value, how much does this stock move? If you take a stock that's really, really volatile, like some of the biotech stocks, the implied volatility can be huge. So you're going to pay a lot of money for that option. And then the time decay. How much time is there left? If you're buying an option that expires this week, the time decay is going to be much, much faster than if it expires 3 weeks from now, because there's much less time for the stock to get to your strike price. Right, so that's what makes up the option premium price, just so you're aware of that. Okay, now, and I just went over this briefly, but the intrinsic value of an option versus an extrinsic value. Okay, so here's an example. A $50 option on a stock trading at 55 has an intrinsic value of $5, obviously. The stock is trading at $5 higher than your strike price. So that option is going to be worth at least $5. The extrinsic value is the option price minus the intrinsic value. So let's say you want to buy a $50 option and it's not trading at $5, it's trading at $6.25. The extrinsic value on that stock is $1.25. $5 intrinsic and $1.25 of an additional premium that's being added in there by the market makers for implied volatility and for time decay. So that's what you're paying the extra money for. The extra money is what's going to be susceptible to time decay and any kind of implied volatility difference. Also important is the volume of options traded at the strike price and the expiration date, as well as the open interest, etc. This is just what we want you to know, how much open interest there is and how wide is the spread to determine whether it's a good trade or not a good trade as far as options are concerned. So but that's basically, you need to know that, because if you're looking at a stock that's, for example, a $60 option on a $55 stock price, if the stock is 55 and you're paying 60, it's going to be real cheap. There's no intrinsic value or not. But let's say they're selling it's selling for $2, or let's say $2 for a $55 option, for a $60 option on a $55 stock. The stock's got to go up $5 to even get to being at the money. So all the while that the stock stays below 60 every single day, you're losing time on that. So the premium is going down, 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 unless that stock gets up in the money. If it doesn't get to $60, that thing is going to expire worthless. There's no intrinsic value in it at all. Okay, and this, I know this may be a little bit confusing if you're not familiar, but I just kind of wanted to give you the basics of this information. All right, the Greeks, we'll touch on the Greeks here. Delta, this is one of the things that I use a lot. The delta tells you how much the option price moves in relation to a stock price move. So a delta of 50, which was what we saw on the Bristol Myers at the money, it's going to move 50 cents for every dollar the stock moves. So the higher your delta is, the more the option is going to go up as the stock price goes up. If you've got a delta of 70, the stock goes up $1, the option price is going to go up 70 cents. All right, so that's important. And for me, when I'm buying options, I'm looking to get a delta of 65 to 75. I find that my ROI is best at right around 70 delta. The theta, which is time decay. This is the decrease in value of the option price as expiration date approaches. This is not a linear reduction. The price starts to reduce very slowly when you're 3-4 weeks out and accelerates. And when you get into the last week, and especially the last 2 days, time decay is just ripping. I mean, the price on the option is dropping much, much faster. So it's not linear, it's parabolic like that. And gamma is called the rate of change in delta. High gamma means the option price can change dramatically with only a small price change in stock. And if you look at a stock that's some news comes out on and the stock is jumping up dollars at a time, then what happens is the gamma, which is the rate of change in delta, goes way up. So the delta can go from 70 to 100 in no time. And actually what happens sometimes on these stocks that are moving up really, really quickly is this is basically the volatility. As the volatility increases, the stock price can actually, the option price can actually go up in value faster than the stock price because there's so much volatility built into it. But it's a double-edged sword, because once the stock loses momentum, it starts to level off. As the stock price moves sideways, the option price can come down because the implied volatility is coming out of that and the gamma is getting lower. Okay, let me see a couple questions here. The intrinsic value will go up as the stock price increases. Does the extrinsic value also go up? No. The extrinsic value is always going to be the difference between what the stock price is and what the, in other words, if your stock is going up in price and you start with a 50 delta and then it goes up and the delta goes to 70, your extrinsic value is going to go down, because there's going to be less premium in that option. That's basically going to be extrinsic value. There's going to be less time decay and implied volatility that's going to make up that portion of that, unless there's a huge increase in the volatility in the option. Do I take higher deltas if they're available? Yeah, you can. you have to balance this, because when you take a high delta like an 80 or an 85 or a 90, yeah, you're getting good movement in the stock, but also you're paying a lot more for it. So your return on investment is going to be lower at a higher delta, but it's going to move up faster. So if you get a sideways move in the stock, you're going to be more protected by your higher delta, but you're also paying quite a bit more for the premium. So you have to kind of balance that. All right, so these are the primary option strategies that I use, and what I guess most everybody uses. You can be long calls or long puts. We do a lot of these. We're going long if the stock, we like the stock to go up, we go puts if it's going down. You can do a put credit spread or a call credit spread. This is a fairly non-stressful strategy. There's a lot of criteria that you need to use to get this, but this basically this collects premium as the time goes by, as you get closer to your expiration date. You're just collecting premium each day. Basically, you're harvesting time decay from the people that are buying the calls or the puts. Put debit spreads or call debit spreads. This is a credit. You get when you do one of these, you do a credit spread, you get money coming into your account. A debit spread, it's just what it says. It's a debit going out. Debit spread does a couple things for you. It capture your risk. You're not going to be paying as much for a debit spread as you are for a straight call or a straight put. But you're also limiting your upside potential if the stock goes above the short strike that you sold. A debit spread is made up of buying a long call, for example, and selling a long call, selling a call short, or buying a put and selling a put at a lower price. So you're actually creating the spread, but it's costing you money. But they do reduce your exposure. So if you don't want to pay a lot of money for like Tesla or Amazon or something, you can do a debit spread. Calendar spreads, which we call time spreads, is something that we do in the room and on the alert service. Basically, what we're doing was for a time spread, we're selling a call for this week and buying a call for next week. The whole point of that is to harvest the implied volatility crush. There's things called condors, which are basically a put credit spread and a call credit spread on the same stock. I don't do any of these. It's a neutral strategy, but to me, they just don't make enough money to make it worthwhile. You can do butterflies. We had somebody ask about butterflies. Butterflies is basically you're trying to identify where the stock price is going to end, and you create a butterfly to actually get into it really, really inexpensively. And you can a lot of times get 3, 4, 5, 10 to 1 on something like these, but you have to be right. If the stock is quite a ways away from where you thought it was going to end, then you're going to lose most of your premium on those. And then there's things called strangles and straddles. A strangle is taking a stock, for example, that's trading at 100. What you do is you buy a $101 call and a $99 put. You don't care if the stock goes up or goes down, but you just want it to move a lot. So you're paying for a put and a call. One of them, if it goes into the money, one of them is going to make money, the other one's going to lose, and you're looking for a move big enough to cover the difference. And a straddle, which is a very, very similar. This, if the stock price was 100 on a strangle, you'd buy a 101 call and a $99 put. On a straddle, you'd be a $100 call and a $100 put. You're just straddling the price. Right? Those are the basic option ones. Now I just break down. People thought this was a good idea, so bearish, bullish, and neutral strategies. If you like a stock bullishly, what option strategies can I use? Well, I can do a long call. I can short the put. I can do a put credit spread, or I can do a call debit spread. Those are all bullish strategies. A bearish, I can do a short call, selling a call, which I would never do. I would never recommend anybody does that by itself, not a naked call. You can do a long put. You can do a call credit spread or a put debit spread. These are all bearish strategies on options. Now, neutral option strategies are condors, straddles, strangles, and time spreads. These are all don't care which way the stock moves. Condors, you don't want it to move a lot. You want it to stay within a certain range. Straddles and strangles, you want it to move a lot. One way or the other, you don't care which one. And time spreads, when we do time spreads, we're just looking for the stock price after earnings to stay within a certain percentage, either up or down. If the market makers are expecting a 15% move, we want the stock to trade less than 15% up and less than 15% down. If that's the case, we'll make money on that. All right. So that's kind of a quick review of options. And I know there's a lot of information there, but I just want to kind of cover the main stuff. All right, so these are the option strategy setups. Puts, credit spreads. Fairly common, we use this a lot. Sell a put and buy a put at a lower strike price, receive a credit. Call credit spread. Sell a call and buy a call at a higher strike price, receive a credit. Put debit spread, you buy a put and sell a put at a lower strike price for a debit. And call debit spread, buy a call and sell a call at a higher strike price for a debit. Once you do these, they're really not very difficult. Calendar spread, we just talked about that. You sell a put or a call at a near expiration date and buy a call or a put at a later expiration date. Basically, it's you're going out a week or more for your second strike, or for your second leg. Time spread was a specific calendar spread, right? And we use current week's expiration and next week's expiration. Typically, I'm selling this week's call at the money and buying next week's call at the money and looking to harvest the implied volatility crush when the options come out, when the earnings come out. And we just went over this strangle and straddle. All right, so choosing the best option, there's a lot that goes into this. You know, what's the best strike price to use? What expiration date should I use? What delta should I use? As I said, I typically use 65 to 75 on the deltas. And the strike price is going to be dependent on the delta. The strike price is going to be kind of determined of what delta I'm looking for. And the expiration date, even if I'm doing a stock that I think I'm going to exit today, I'm usually going to go out at least 2 weeks. If I think I want to stay in it longer than that, I'll go out 3 to 4 weeks. All right, so that kind of wraps up the options portion of this. I could go on and on about this, but what I want to do is I want to go over some of the trades that we've taken using the compass system and the criteria, show you what they are, and then we'll go over the information as far as the alert service, the compass trading room, and the compass system itself. Let me just grab a quick drink of water here before I get dried out. Now let's see, Joel, question on the time spread hedge last week. Okay, should the number of contracts of the put credit spread been equal to a number of time spread contracts? You're talking about on GME. Yeah, that's what I did. I took the same number. If you remember that one, we caught the time spread cost us about 30 cents, and it went against us hard. The stock just gapped way down. So we did a debit spread, and we get into the debit spread for about 30 cents, and we get out for a little over 60 cents. So we actually scratched the trade and made a little bit of money on it. I mean, if you're trying to hedge, you don't have to hedge with the same amount, but if you don't hedge with the same amount, you probably what you're doing is you're reducing your loss, but you won't get a profit. Yeah, the hedge was a debit spread. It was a put debit spread, Joe. Yeah, you'll be able to get a presentation, a copy of this webinar, Dwayne. Thanks, you like the presentation, I appreciate that. All right, so let's just run through some of the look charts. This is Lulu. I pointed this out this was one we just took this month. This was a put debit spread we took overnight. We get a 56% profit in this. We entered at $1.92. We get out the next morning at $3, and it's a debit spread. You see, we have this is a pretty high price stock, $356 stock, but it only cost us $1.92 for a debit spread. And we had a $5 wide spread on this thing. And this is where we get in, and I want you to see why we get in. Here's our compass system, okay? So everything was obviously bearish. They were selling. This is the daily chart. They were selling Lulu. They would switch to blue briefly as it compressed, and then went back to yellow. Right here on this candlestick is where we took the debit spread. As everything went yellow and red, it was coming out of compression to the downside. We took it right here, and we get out right here, and that little bitty blip right there in that debit spread get us 56% profit on Lulu. And this is again, this is the compass system that shows you all the information that we had here to make that decision. This was one for Shake Shack that we took a 2-day trade on, 26% profit. Obviously, the institutions are in here. Here's the earnings. You can see how the stock, see how it's compressing right here, going sideways. Look at all the green. Institutions are buying the heck out of this thing. And this pink line, by the way, is a VWAP. This is a daily chart. I do not use the VWAP on a daily chart, only on the 5-minute. But Toss puts it in there anyway. So this is where we bought this right here. As it came out of this compression, moved to the upside. This is the 15 EMA of the EMA, a smooth 15 EMA. This is where we bought it, and we rode this thing up for 2 days, just 2 days, from here to here to here, 26% profit. Here's workday. This was a 5-day trade for 30%. Nice move here. We actually get in right here when everything went blue and green. Then it went back to yellow. So we had to be cautious when we started getting yellow and the multi-time frame momentum. But the current time frame stayed bullish, and the trend stayed bullish. So we get in here. It was, you can see, it was popping out of compression here, and we rode this thing up. These are Hikinachi candles, by the way. This takes 2 candles to make it one of these. So we were getting confirmation. See how this candle had a tail on it, and this candle has a flat bottom? That's a Hikinachi reversal candle. And I have a whole video on this, and I do this in the webinar sometimes to go over Hikinachi, but these are Hikinachi. So this gave us the ability to buy it right here. This is a dynamic compression zone that the compass system puts on there automatically. Obviously, it's breaking out of there. So again, we took this 5-day trade for 30% on workday. And it was getting kind of choppy here. You can see the multi-time frame was going back and forth. So I didn't want to overstay my welcome. GCT, another nice one here, 2-day trade for 26%. This is a daily chart. Comes out of this dynamic compression zone, breaks out of compression. You can see, we pop it right here, and we get 26% in 2 days. And you see the compass system is guiding me on all these. You know, this was a compression here on MDT. This went yellow to blue, so I knew this was going to bullish. We had bullish across the board. We take it right here off this 15 EMA, and we ride this right up. And we were in this for a few days. See how it just kind of goes sideways. But we knew the institutions were buying it. We just had to give them time, and then it popped. VKTX, another good one right here, daily chart, 30% profit in 3 days. Breaking out right here on this big candle. Everything's green. We want to be in it. We take it off right here. This was a nice one. This was on McDonald's. This is an overnight trade. This is the daily chart. We were in for 8:30 and out for 11:30. We were in this just overnight, really, really quickly. It was $3 profit on a contract, 37% gain. See this breakout of dynamic compression right here? See the pop out of the box symbol? This confirmed that we were breaking out, was going to continue. We took the trade right here. We get out of the trade right here in 1 day and get out. Came back, it turned bullish again, but we only wanted to just take that overnight, which is what we did. I'm not going to give up a 40% gain overnight. So crowd, and these are again, you can see here what we get in here. See the choppiness here. We took a 20% profit in this. We just did this, even though the candle shows day here. This was an intraday trade. We were just using 5-minute candles to get the in and out of that trade. Amazon, same thing. Again, I don't want to drag this out too long. I could show you chart after chart after chart, but you can see how the compass system is telling us that this was a good setup. Now the money, this was the long-term trend, was yellow because it had been compressing for so long. But the short-term momentum and the multi-time momentum was all green as the money flow was. So I had no problem taking that. And we were in this for just 45 minutes. 45 minutes out here and out here. ENPH, see, it works to the short side. I mean, how hard is it to know that the institutions are selling this? But the idea is to try to find the best entry. See this compression right here? Pop out of the box signal to the downside. It's below the VWAP, right? This is the VWAP on the 5-minute. We want to be below here. We're below it right here. We pick it up right here. We're in this thing for an hour for 20%. This was a beautiful one in Verizon. Verizon is a very low, option prices are very low. In the money options are cheap. The stock doesn't move a lot. We get in here for 45 cents. We took an in the money call for 45 cents. It was out, I think, next week. And we stayed in it for 1 hour, and that 45 cents went to 67 cents. Now, if you bought 10 contracts, that would have been $450 to buy 10 contracts of that Verizon. And an hour later, you would have been out for that 450, turned into 670. that's pretty good. And I mean, you see the coming off the VWAP, you see the pop out of the box symbol. I mean, and everything's red. It's just not that hard to when you see that stock. It's not that hard to see which way to trade it. This is a super system setup right here. You see the SPY. We had the market internals in our favor. The SPY's got a pop out of the box signal right here. It's below the VWAP. It's coming off the 15. Everything's set up beautifully. Everything's red. We buy it here. We get out right here. I think we made about 35% on that SPY trade. And Tesla, we'll take some overnights off of these as well. This was showing a pop out of the box symbol on the day chart right here, on the 5-minute chart. I mean, at the end of the day, this is the end of the day. So we took a short overnight because everything was selling, and sometimes you get lucky, and the stock fell from 120 to 112. We had the puts exploded. We get out right down here. Those puts went up, I think, about $7 a contract. It was a lot. All right, so that covers the charts. Again, this is just kind of a recap of what we do in the room and what we do on the alert service, the different strategies that we do. I've covered most of those, and I'm going to cover the offer. I just want to see if any questions here before I go on. Let's see. Now let me just run through this, and then I'll get back to the questions. So in case anybody wants to see this, this is the alert service. We've got a 50% off special offer on this thing. The alert service, if you get into the alert service for a full year, it's just $7.98, which is, to me, is really dirt cheap for alert service. You can try it quarterly for $2.96. If you get in, you get a month in the live trading room. You also we have a Discord room, a chat service where we have 2 additional professional traders in there, Dr. No and Savvy Trader, and they post their charts of the high probability trades. They answer questions. A lot of good information in the Discord. You get into there. Obviously, you get the alert service since you just signed up for it. And then I have about 25 videos on the different strategies we use and the indicators on the Compass system and how to find the very best trades using the Compass system, and then also deep diving into technical analysis. So that's the alert service. The trading room is $849. Now the trading room contains the alert service. You get the alerts as well. So $849 for the trading room. You can do it for a month for $148. I don't, I mean, that's fine, but I don't think a month gives you a big enough test to get used to the service personally. But they want to let people have an opportunity to get in, so that's fine. Again, you get 1 month in the trading room. That's not really true. If you're paying for the whole thing, you're in the trading room. So you're not getting a month in the live trading room. If you get in for a year, you're getting a year in the trading room, and you'll also get the SMS service. And if you're interested in the Compass system itself, I didn't go into a lot of detail on it, but it's a piece of software that gets loaded on ThinkorSwim. The right line technicians will put this on your machine for you. You don't have to worry about the setups. It'll look exactly like mine. It comes with scanners. You'll get the scanners as well. All of those come with the Compass system. And again, that's an annual of $1249 for a year. And you can use it. You can use it if you're in the room, not in the room, doesn't make any difference. You can use it for your own trading. But you'll get my entire workspace. Again, it's going to look exactly like what I have on the ThinkorSwim platform on the room. I during the trading day, I have that Compass system up all day long, and I've got the SPY up there, and then I switch back and forth to different stocks we're looking at. People ask about individual stocks. What do you think of this one? And so we'll go over, we'll look at it on the Compass system and see what it looks like. Bullish, bearish, is it a good trade or not? All right, so now let me just look at some questions here. What is my stop and how do I determine? As I said, my stop is based on technicals. If I've got a stock that's still bullish and it's above any kind of support levels, still above support levels, I'm going to stay in the trade until it breaks the support level. Now, as I get closer to expiration, I might have to decide to take it off or roll it forward. But as soon as it breaks my support level for a long and my resistance level for a short, then I'm going to exit the trade and take the loss. But as long as it stays bullish, I'm going to stay in it. Or bearish for sure. Brian, how many time frames are involved in the multi-time? Yeah, I use There's 3 time frames involved here. You're looking at, on a 5-minute chart, you're looking at a 5, a 15, and a 45. They all have to be aligned. All momentum has to be up, money flow has to be, and the trend has to be on all 3 of those. If you're looking at a daily chart, it's 1 day, 3 day, 9 day. How do I decide when to enter on a 5-minute versus a daily? Well, the daily tells me that I want to get into the trade. Then I look at the 5-minute chart and I try to find a good entry on the 5 minutes. Once in other words, it comes back to support, it's above the VWAP, I'm getting a reversal back into the trend, then I try to find the best place to get in, bouncing off of a support level. The daily chart just tells me that I can stay in it all day if I want to, or overnight. And if I'm in a trade for like multiple days, if I'm taking an overnight trade, I'm not going to get shaken out of it on a couple of really crazy 5-minute candles the next day. I'm waiting to see where it does at the end of the day. I'm just using the daily chart to determine that. Bill, thanks very much. Appreciate it. John, you have a small account to avoid PDT. How to determine exiting times in the same days? Do you give many of these intraday trades? I do have intraday trades. The thing is, if you're a PDT, if you're under pattern day trader rules, couple things. Time spreads, put credit spreads are never going to impact your number of trades as a day trader, because those are both going to be overnight. Credit spreads, time spreads will always be overnight. Now, if I get into a trade, I don't know if I'm going to have it overnight or not. I mean, sometimes I'll just get out quickly, but if it pops, I'll take it off. But if you're under a PDT rule and you can't get out, all right, because you can't take another day trade, remember the daily chart is still bullish. The likelihood of it being able to stay in that overnight and still take a profit down the road is very, very high. Okay, good questions. Good questions. I appreciate that. Go to CELH. Well, I don't have a live chart up over here. I have CELH over here. Okay, I'm looking at on my TC2000 chart. I'm looking at CELH. John, I don't have ThinkorSwim open right now. But do you have a question on CELH? It's bullish. It's just breaking. It's just going above the 8 and 15 EMA. It's off the 100. It's looking to try to break out. It's a decent setup for a breakout next week. And I do use TC2000, by the way, for my charting. I use TOS for the compass system and for the indicators, and I use TC2000 for when I'm doing charting. You want to know what the compression would show? Well, I don't have TOS up right now, so I can't look at it. I'd have to open it up. I don't have ThinkorSwim open today. You want to know what it would look like? Yeah, I don't know. I'd have to load up TC2000. I'd have to load up the compass system. I'm guessing right now that it's probably neutral. It might have just switched over to green or blue on Friday, but I don't know. And it depends on what time frame you're looking at. I can guarantee you that the daily is likely right now showing bearish to neutral. Okay, thanks, Marvin. Appreciate it. Yeah, if I look at it on TC2000, it looks different. This is what he's looking at. Right? This is sell H. Right? So this is a see this pull down here. Here's the 50-day moving average. You see, it's just trying to recover from this low right here. It's not bullish yet, but it's in a bullish setup. See this is called a bull flag. You see this big volume right here, and this is a big bullish candle. The stock is trading inside this compression zone right here. This is basically a bull flag. When you get high volume and you get reduced volume as the stock just kind of churns around. So it's still bullish. It's not a bearish setup, but you've pulled back right now. You wouldn't want to be going long until you get above this orange line and this white line. We talk a lot about this in the room. I mean, in the room we spend a lot of time going over these stocks that people are interested in. So I appreciate the question. So anyway, these are here's your offers. alert service, $7.98 for a year, $2.96 for a quarter. Again, you'll get a month in the live trading room. You'll also have access to the Discord room, and you'll get my videos, to training videos. There's about 25 of them. They're about 30 minutes each. They're not excessively long. Trading room, the live trading room again, $849 a year, $148 a month. Obviously, you get a month of the live trading room. You get a year in the live trading room, but you'll get Discord. You'll also get the alert service with that. And there's the Compass system. That's the software. If you're interested in the Compass system, this is where what you want to get. Brightline will put it on your machine on ThinkorSwim for you, or a Ninja if you want it on Ninja. It'd be called the Money Flow Tracker. Whatever you use. Again, you don't. If you've got Compass on TOS, you don't have to trade on TOS. I don't trade on TOS, but that's where the Compass system resides. Now, inside the chat box here, if you look at the chat box, you'll see the offers links for all three of those things: the alert service, the room, and the Compass system. And you can check them there. You can also call Rory anytime you like. Sorry, Rory, but he's pretty swamped down there. But you can call Rory. It's in the chat box. His number is in there. All right. So I think that's we've tied up about an hour and 20 minutes here. That's kind of longer than I wanted to, but I know the option stuff can take quite a bit of time. But I just want to get it out there for you to see what some of the information you need to know to learn to trade options. All right. So listen, thanks everybody for being in the room. I appreciate the webinar. Appreciate you being at the webinar. Appreciate you taking up part of your weekend. What is the name of the service I trade through? The service, you're talking about my platform? I trade through Tradier, 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 and I use TradeHawk as the front end to Tradier. I don't really like Tradier's platform itself. I use TradeHawk, but TradeHawk feeds my trades into Tradier, and Tradier is where they get executed. I fund the account through Tradier. Because the options, it's because the commissions are ridiculously cheap. I do an awful lot of option trades. I mean, thousands of option trades and, contracts in a month. So it doesn't cost me anything. I pay like $20 a month for everything, options and stock. And I don't pay any commissions above the $20 flat fee. So it saves me a massive amount of money. So it's $100 more for the room in addition to the alerts. That's correct. Yeah, I mean, that's pretty good. I mean, if you get the alert service, you're going to get a month in the room. But if you buy the room, you're going to get the alert service. So even if you can't be in the room every day, to me, it's worthwhile anyway, because you can get in there and ask some questions and see some additional trades that you may have not seen on the actual alert service. Can you do SPX instead of SPY? Sure, you can do SPX instead of SPY. You can use SPX, you can use XXP, you can use SPY, you can use whatever you want. I mean, you can use the same, anything in the Compass system on TOS is if you can put it on TOS, the Compass system will give you the setup for it, whether it's SPX, QQQ, anything, gold. You can do futures, gold futures, it'll show up there. Anything you want. More money. I'm not sure what more money means, Marvin. Yeah, the SPX is more money, sure. It's 10 times as much. A lot of people use SPX, and they'll do butterflies on it, they'll do triangles on it, straddles on it, all that kind of stuff. You can use trade anything you want. Just depends on your platform, what your platform lets you trade. Compass, if you can put the stock symbol in and TOS, Compass will put it out there for you. They'll give you the indicators on it. All right, everybody, listen, thanks so much for being in the room. I appreciate it. I appreciate all your time to listen. I hope you have a great weekend, and I hope to see some folks in the room on Monday. Have a great weekend.